Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. With this particular video, I'm going to cover 9 research candidates in the consumer durable sector as reported by FactSet. This is kind of an interesting sector to me because one of the things about investing in durables are that they're durable. The products that these companies sell generally are durable, which means last or can last a long time. So consequently, you're going to notice that as I go through the 9 research candidates I'll be covering in this video, that there's a lot of sensitivity to recessions, especially what we saw during the Great Recession. People can postpone the purchase or they can keep, old Betsy if it's an automobile, or in this example, a motorcycle. They can keep it for an extra year or two if they need to. But then coming out of a recession, when economic times get better, these companies also tend to recover very fast. But I do believe it's important to look at a long-term record of companies. And then what I do, as I mentioned in the written portion of this article, I like to start long and then kind of shorten the time frame incrementally to get an idea of what the company's long-term future is. Although you can't invest in the past, you can certainly learn from it. Now, I also want to point out I'm going to be covering 9 companies here. So I hope you understand that, my review of these companies is really cursory. It's just an introduction. So I encourage all of you to dig deeper if any of these stocks are of interest to you. But I'm starting out here with Harley Davidson. I'm going to do these in order of the highest dividend payers to the lowest, and 2 of the companies in this group don't even pay a dividend. But what I want you to notice, first of all, I've got earnings here. That's the orange line on the graph in the green shaded area. And you can see the company had great growth. It did actually pretty well during the recession of '01, but then during the Great Recession, Harley Davidson collapsed. You can see that they cut their dividend dramatically. That's the white line here on the graph. But then I also want you to notice what happens to price. Now, we had a period during 1999 and 2000 where you had what Ellen Greenspan called the irrational exuberant period, where valuations were extremely high. And then coming into the recession, by the way, in 2006, Harley Davidson was actually trading at a very high valuation. But then as the earnings crumbled, you can see the orange line fell, the stock price tracked that. And then as we came out of the recovery here, the stock price rallied very strongly. And then since 2014, Harley's been performing kind of flatlining again. So if I shorten the time frame, you could see that there's been virtually no growth, less than 1% growth since 2015 or end of 2014. And the stock price, of course, has reacted to that. So what I find attractive about this company right now is its extremely low valuation. The next company I'm going to look at in order of dividend yield is Leggett & Platt. And this is a manufacturer of bed springs and other products in the home furnishing sector. Now, this one isn't really attractively valued. When I first ran this screen, the stock was reasonably cheap. It's a little pricey. It does offer a 3.7% dividend yield, but I do think this one's a little pricey. Now, it is a dividend aristocrat. So, this is a company that has increased their dividend every year. So they have a great dividend record. But I do want to once again point out that their record during both recessions was very spotty. So people, keeping the old bed spring a little longer during bad times, and it didn't recover as strongly. However, what the salient feature of this company is its dividend record. If you look at its long-term dividend record, the average growth of their dividend has been over 8.5% over this last 20-year period. And again, it's a dividend aristocrat, which means it's increased its dividend for 25 consecutive years. Good company, does have a little bit of debt, BBB rated. You can see what happened when it was overvalued back in 2015 and 16. The next company I'm going to cover, I've covered recently, and many have commented. I'm going to go to Whirlpool. Whirlpool is also an interesting consumer durable in that, they had a couple of things happen to them. They had, during the recession, they didn't do very well. They kind of were flat during the last recession, but there was all the talk about steel tariffs and stuff really took this stock on a significant ride. I believe it's significantly undervalued, and I think you can see that that valuation is looking like it wants to revert to the mean. Once again, if I look at just a shorter time frame, the growth has been rather attractive here over shorter time frames. It's been 12% since 2018, where if I go to the all graph, the long-term graph, it's only been about 6%. So be careful when you're looking at consumer durables. Coming out of a recession, they can look extremely well. The next company I'm going to cover is Snap-on Tools. This is a manufacturer of tools. This is an interesting company. It's a dividend challenger. It's got a really good dividend record. It also had issues during the recession, but they were minor compared to what we saw with Harley Davidson, for example. But we do see a big drop in earnings, a 43% drop in earnings during the '09 recession. But this is one of the more consistent growers in the group. I chop out 2001 there, the last recession, and you can see it's averaged about 11% growth. Since coming out of the recession, the growth rate, let me shorten that one more year, the growth rate's actually been almost 17%, and you can see the price has tracked that very nicely. I do consider the stock undervalued. It has a decent dividend yield and a really excellent record of growing their dividend historically. So this is one that I think is just a solid, attractive company. It's A- rated, only has 22% debt. Of all the companies in this group, I probably like it the best from a standpoint of quality, the perspective of quality. I think it's really the best in there. And then my next candidate I'm going to cover, I've also written about recently, and that's Stanley Black & Decker, which is also in the tool business. And again, when you look at Stanley Black & Decker over a long period of time, you see kind of flatness in their '01 recession. You see a couple of really strong down years. But again, I want you to notice as I go through all these charts how the stock price really relates in the long run to the company's operating history. Where the orange line goes in the long run, the stock price goes. And then when you get these periods of high valuation, you see a reversion to the mean. Periods of low valuation, reversion to the mean. This is just a good solid holding. A-rated, 32% debt. You know, next to Snap-on, it might be my second favorite company in this group. Valuation is not real low, though. It's fair, but it's not extremely low. Once again, since coming out of the Great Recession, it's put together some decent growth, and it was a stock that was pretty significantly overvalued in 2017. So it's one that I do think you can consider. The next stock I'm going to look at is the sporting goods manufacturer Brunswick, you know, famous for maybe their bowling more than anything else, their recreational products. But once again, I want you to see what the nature of a consumer durable. Just a tremendous collapse during the recession, tremendous collapse during the Great Recession. They cut their dividend and actually had losses, strung together 3 consecutive years of losses, but yet the stock actually started to respond in the anticipation that they would do well coming out of the recession. If I look at this over the last decade or so, you can see that their growth rate has been over 17%. The stock is cheap. It's a BBB- rated stock, 42% debt. It's reasonably attractive. The forecast for a flattening of earnings in 2001 is something that I think, you know, as a prospective investment, you want to be aware of the fact that there is some cyclicality in this stock. But again, I think looking at the long-term nature, if you had a significant downturn in the economy, this could be a very tough hold. Now, the next one I'm looking at, in fact, the next 3 companies I'm going to look at are sort of related. I'm going to start with D.R. Horton first. We find it here for you. Thanks. I couldn't read my own graph here. I'm going to start with D.R. Horton. Again, I'm doing it as an order of the dividend yield highest to lowest. Once again, you see what happened to the home builders, keeping in mind that this Great Recession was primarily a result of excessive lending for home building and other real estate transactions. You had all these collateralized debt obligations that were toxic. And of course, you know, when that all crumbled, the Bank Americas and the Citigroups, etc., collapsed, so did the builder D.R. Horton. They slashed their dividend from 60 cents down to 15 cents. But then once we kind of got past the recession, again, I run this as a 10-year graph, we had really tremendous growth, over 30% growth. I'm going to put the normal PE on here. This stock trades at around a 15, 16 normal PE. It's currently trading at a 9 PE. But we are starting to see a little bit of a few cracks in the what I'll call the home building surge that we've experienced for all these years previously. So that's partially maybe explains the undervaluation. It's something I'd be, you know, very careful with as I looked, you know, further at these companies. Now, the next stock I'm going to look at is the carpet manufacturer Mohawk Industries. Again, very housing related. This particular stock pays no dividend. The last 2 stocks I'm covering here pay no dividend at all. I want you to notice that the price tracks earnings. We had the recession. It went into negative earnings growth growth again. We saw the stock price collapse during that period of time. Then we've come out of the recession and we had some really strung together, some really great years. You know, performance over this time frame was really exceptional. If I just calculate it real quickly, you could have averaged over 34% a year from September of 2011 through December of 2017. That's really some spectacular performance, but the stock also got overvalued. Then we get a kink in the armor. The earnings, fell in 2018 and they're expected to fall again next year. And so now from that stellar performance we saw there, now you've had, over a 50% decline. But I do think it's also created a significant level of undervaluation. But I want you to recognize that the undervaluation is also functionally related to the weak earnings here. And again, this company pays no dividends. So that's your Mohawk industry. And then finally, last but not least, I'm going to take a look at another home builder. A little bit different than what we saw with the first one. NVR is a little higher quality homes and so on. Their earnings collapsed during the Great Recession. Their stock price tracked that. They don't pay any dividend. They're BBB plus rated, only have 25% debt. But this again is more of a growth situation. But once again, we're seeing the housing situation. So the consumer durables industry is an interesting industry in a lot of ways. It's got some very interesting companies, and if you're on the right side of the economy when you're investing in these stocks, you can really make some great returns. Like from the bottom of the recession, when the stock was really attractively valued based on a PE of about 17, even through today's undervaluation, you'd have averaged over 23% a year, turning $10,000 into just under $79,000 over this time frame. And that's notwithstanding the huge correction that we had in 2017. But again, you're starting to see some recovery here. So what I wanted you to have is a clear perspective that the consumer durables sector does have some value in it right now, but this is a sector that, because of the nature of the products that they tend to sell, they can be postponed. Purchases can be postponed, and so therefore you're going to see a typical lot of cyclicality and a significant vulnerability to recession. So anyway, these are the 9 research candidates that I've covered just very, very superficially in this video. I just wanted you to really see some of the points that I was trying to cover here, how they are very vulnerable to a recession, but they can come out of a recession and grow extremely, fast. But you got to be aware, if you're investing in these companies, you really want to monitor them carefully and closely and continuously. You want to do your homework here. A lot of the fundamentals are good, debt levels are reasonably low, etc. But be careful when you're investing in the consumer durable sector. It can be real challenging during weak economic times. This has been Chuck Carnevale saying thanks for listening. Appreciate it.